The concept of yield curve is essential to our understanding of interest rate risk. Yield curve is essentially a graph that represents the relationship between yields, that is returns, and the tenor or the time to maturity. As you can see on your screens now, the x-axis of the graph shows the tenure or the time to maturity going from 0 days to 20 years. The y-axis shows the yield or the interest rates. By the way, the responsibility to construct and publish the yield curve for any currency is vested with a specific entity in that currency's country of domicile. Hence, you have, for instance, a US dollar yield curve, a euro yield curve, a GBP yield curve, so on and so forth. The yield curve is constructed every day using the Nelson-Siegel-Swenson model based on the rates that prevailed at close of business for all maturities from overnight to 30 years in that currency market where the currency is domiciled. To understand how an yield curve is constructed using the Nelson-Siegel-Swenson model, please look up the web link provided at the end of this video. Intuitively, the yield curve should be upward sloping because, as you will already know based on your experience in dealing with your own personal finances, shorter the term, lower the yield of the interest rates, and longer the term, higher the yield or the interest rates. Sometimes the yield curve could be flat, sometimes it could be downward sloping, sometimes it could be upward sloping, and sometimes it could take the shape of what we call a hockey stick yield curve. If over a period in time, interest rates in a country are moving up at the long end and remaining constant at the short end, you have an yield curve that is pivoting upwards. On the other hand, if the long-term interest rates remain constant and the short-term interest rates are rising, then you find that the yield curve is pivoting in the opposite direction. Sometimes you will also have a parallel shift in the yield curve, which means both the short-term rates and the long-term rates are going up almost in the same proportion. To understand the yield curve and its relationship with the term structure of interest rates, we will discuss two underlying theories pertaining to the term structure of interest rates: pure expectations theory and liquidity premium theory. There are other theories governing term structure of interest rates which will not be discussed here. Let's first look at how the pure expectation theory impacts the yield curve. Assume the yield curve is flat. In other words, you have a graph that looks like what you see on your screen now. Irrespective of the tenor, the interest rate is the same. That's a very hypothetical situation. Rarely ever happens in any market. Let us now examine how this flat yield curve swivels in one direction or the other based on the expectations about the macroeconomic factors in that currency market. Here's an example. Assume that the general expectations is interest rates will rise going forward. If you are a saver or an investor, you will invest in the short-term securities, since you would like to invest in the longer-term securities when the yields of the interest rates go up. In other words, a lot of money flows into the short-term market in the expectation that when interest rates rise, the savers and investors could switch their investments to the longer term. Hence, there would be excess liquidity in the short-term market, and as a result, the flat yield curve that we started with will start pivoting downwards because of excess supply of money in the short term. On the other hand, if you are a borrower, you will prefer to borrow right away for the long term because you know that as time goes by, you will have to pay a higher cost for your borrowing. Because interest rates are expected to go up going forward. What this means is that anyone who wishes to issue debt securities or take a loan will immediately go for long-term debt, either bonds or loans. What does this do? The demand for funds at the longer end of the yield curve will go up. Therefore, the yield curve will pivot upwards at the longer end. As a net result, what was a flat yield curve when we started would become upward sloping. The situation will be the exact converse if the expectation is interest rates will fall going forward. Next, we look at the impact of liquidity premium theory on the yield curve. Liquidity premium theory simply states that short-term maturities imply greater liquidity, and therefore savers are willing to hold securities for a longer term if there is a premium offered on the yield or the interest rates. In other words, the longer you keep your money invested somewhere, the higher the yield or the interest rate you would like. In effect, liquidity premium increases the slope of the yield curve. Short term, lower interest rates; longer term, higher interest rates. Therefore, the yield curve should be sloping upwards if liquidity premium theory was the only theory that was applicable. Remember, the yield curve is applicable only for a particular day. Hence, to see the trends in the movement of yields and interest rates, you will need to study the changes and movements in the yield curve over an extended period of time. That was a quick review of yield curve and factors that impact the shape of the yield curve. In the forthcoming sessions, we will look at measuring and managing interest rate risks using repricing gap model and duration gap model.